Rate cuts. A lot of analysts, market watchers, and investors expect to greatly boost the performance of REITs in the near term. I mean, I get where they are coming from. After all, the IHS REIT index did jump by 18% between October 2023 and December 2023 after optimism of rate cuts happening in 2024. While much of these gains have since been clawed back due to the stickiness of inflation figures in 2024, there's no sort of optimism that rate cuts will be a penalty for performance of S-REITs. Personally, I don't share that sense of optimism and feel that any rate cuts only provide a small incremental upside to performance of S-REITs. And here are my reasons why. If you look at the dot plot table and market expectations, many expect the benchmark interest rate to be the 4.75% to 5% region by the end of 2024. This represents a 50 basis point decrease from the current 5.25% to 5.5% region. At this market expected interest rate region, it remains higher than pre-rate high interest rates, where most S-REITs are locking the majority of our debt at. As a recap, the US Federal Reserve did its first rate hike of this current interest rate cycle back in March 2022. So for any REITs that are refinancing pre-2022 debt in 2024 or 2025, they're effectively exchanging low-cost debt for high-cost debt. If you're wondering how big the difference in interest rate could be, the Singapore overnight rate average, otherwise known as SORA, was at 0.3% after the first rate hike and currently sits at close to 3.55% as of 24th May 2024. Also, the impact of interest rates could be mitigated with interest rate swaps. They will still not be able to fully account for the rise in finance costs. Thus, for REITs that are refinancing their debt in 2024 or 2025, expect their finance costs to increase, which means continued pressure on the distributions, even if rate cuts were to come into play. But what of REITs with no refinancing concerns in 2024 or 2025? Will such REITs benefit more from rate cuts in 2024? The short answer is yes, but also depend on the proportion of their debt or floating rate loans. While REITs with a higher proportion of floating rate loans will benefit more from rate cuts in 2024, investors should not expect finance costs to substantially decrease in the near term. This is because when it comes to REITs related to no refinancing concerns in 2024 or 2025, many will already refinance their debt to higher rates at the height of this interest rate cycle, thereby in a sense already realizing the increased finance costs. This explains why many REITs experienced a significant increase in finance costs in 2023 as compared to 2022, with finance costs likely to remain elevated even with rate cuts. I feel the operational fundamentals will have a more lasting and significant impact to REITs performance. Now put it this way, while rate cuts might temporarily uplift the performance of REITs in the near term, any sustained positive market momentum will still have to be backed with financial numbers. This means that investors need to invest in REITs with a good track record, both in terms of delivering positive financial results and also overall management of the REIT. A good place to start is looking at REITs that perform well or be rather resilient in this interest rate cycle. After all, if these REITs can thrive or be resilient during tough times, there's a high chance they're likely to perform well in better times. With that said, investors still need to consider the REIT prospects and also how well the relevant sectors will perform in the medium to long term. For instance, the performance and prospects of industrial REITs could differ greatly from that of hospitality or retail REITs. There's also a need to think about the broader state of the current economy. What numbers and figures do indicate that the economy is growing steadily? I personally have a nagging feeling that these numbers do not tell the full story. We have seen multiple layoffs in companies across various sectors and industries. With inflation seeming to be stickier than expected, are we seeing early signs of an economic downturn? To be honest, I have really no idea. But on the side of caution, and not be too overly concentrated or leveraged into REITs. As a whole, investors will see rate cuts as a straightforward and foolproof uplifter for most of REITs. The quality of REIT will ultimately be a more influential factor in determining its long-term performance. Investors also need to know the dual mandate of the US Federal Reserve, which is to keep prices stable and achieve economic growth through either quantitative tightening or easing. Thus, do not expect to see drastic rate cuts over a short period of time, because if that happens, it means that the economy is not doing well, which will likely result in a fall in REIT prices overall.